And hello, everyone. Welcome to the Earnings Players April 2016 earnings season preview. We have a great little presentation for you today. I'm very excited because the earnings season is about to get underway. This is our simple trades, 100 to 500% gains idea. We've been doing this for a number of years now. My expert, Jamie Dlugosch, is along with me, and I will introduce him to you in just a couple of minutes. Specifically, we're going to be talking today about 3 trends and 3 trades you can use to pull in some quick, big gains during earnings season. Now, do have to make the lawyers happy at the outset here. So this is a U.S. government required disclaimer. Forex, futures, stock, and options trading is not appropriate for everyone. There is a substantial risk of loss associated with trading these markets. Losses can, will, and do occur. No system or methodology has ever been developed that can guarantee profits or ensure freedom from losses. No representation or implication is being made that using the earnings player methodology, the system, or the information in this presentation will generate said profits or ensure freedom from said losses as well. This is not a solicitation to purchase or sell any of the securities listed in this presentation. You do so, obviously, at your own risk. With that being said, and now that we just told you that you can't make money, let's talk about how you can potentially make money. And that's with our simple trades 100 to 500% gains approach. As I said earlier, we've been doing this for a number of years now during earnings season, quarter after quarter, pulling in substantial gains. I'll share some of those examples with you a little later in this presentation. But this is a trading strategy that is specifically for investors or traders who want to get some fast growth in their trading account, because we trade the earnings season, which the core of that season lasts about 6 weeks. So with some of these rapid gains in a relatively short space of time, but also being able to do this every single quarter, you'll see how you can rack up some pretty big gains over the course of a year. The trades that we target have gain potential of 100 to 500%. That's historically the range that we have consistently seen with the trades that we've made or recommended. Some of our biggest winners have been in excess of, between 486 and 525%. That was a Green Mountain Coffee trade and an AOL trade, which we've made over the last couple of years, just as a range to give you an idea. Last year, we had a number of triple-digit winners. Even last quarter, a number of triple-digit winners. Now, this is specifically an options trading strategy. It's not day trading. You don't have to sit at your computer. We'll show you the actual trading process a little later in this presentation, but we are using options. We are using a simple put or a simple call option in this presentation and what we're talking about here today. And I'll circle back on that a little bit later in this presentation as well. But most importantly, this is a simple, repeatable system that you can use throughout the year to capture gains from earnings reports as S&P 500 companies report their earnings. Now, a very important point there. We only focus on S&P 500 companies, and the main reason for that is because they're part of the S&P 500, because they are traceable or trackable results, if you will. In other words, because those companies are the biggest in America, they're consistently reporting earnings. Their data is accurate. We may not necessarily like the financial engineering that goes on behind the scenes when they report their earnings, but nevertheless, we still have insight into the actual numbers. So it's a key point to understand as well. The reason we use those S&P 500 companies is because they're available on both the weekly and or monthly options market, which means that they have the liquidity available for you to make the trades that we recommend or that we talk about. So with me today, as I said earlier, is Jamie Dlugosch. He's our earnings expert. He's been running the earnings player service with us for the last 4 years. And if you don't know him, he is, or even if you do, just as a reminder, he's a 3-time trading champion of MSN Money's Strategy Lab trading competition. He's also the expert stock analyst for the Millionaire Blueprint program with a 75% success rate on his trade recommendations. He's also an award-winning financial writer, having been the editor and publisher with the Rational Investor, which in 2004 was ranked the #1 newsletter by Hulbert Financial Digest. He's also published additional newsletters, the Penny Stock Winners and the Prudent Speculator. And he's also a trusted investment expert, guest and contributor to financial television, radio, and online networks, which include CNBC, MarketWatch, Traders Reserve, Main Street Investor, our own site, and MSN Money. So Jamie, I want to welcome you and thank you for taking time with us to talk about this quarter of earnings. But as we segue into this quarter, and before we move on to the next slide here, let's go back one quarter and let's talk about the first quarter 2016. And really, one of the slides you're going to talk about has to do with train wrecks. And I think that's the best way to describe what happened in the first quarter for the vast majority of companies. So let's go back a little bit in time and what happened in the first quarter and how do you see that forward momentum or non-momentum affecting the next quarter?
Well, thanks, John. Appreciate the opportunity to be here today and talk about earnings. Always, for me, the most exciting time of the calendar. And it unlike Christmas, that only happens once a year, I get to do it 4 times a year. So super excited as we ramp into first quarter earnings season. Alcoa reported results last night, and already we're seeing some of the trends and potential trades that we're going to outline here today manifest and work as we're expecting them to work. As for last quarter, it was train wreck is a good word for it. You had a lot of speculation that the macroeconomic environment was going to collapse. And while GDP estimates for the first quarter have certainly come crashing down, they are still positive with expectations for second and third quarter reversals of the weakness in the first quarter. But when earnings were released for the fourth quarter of 2015 in January and February of this year, the expectation was weakness. And because of that, it was sell first and ask questions later. And so you did have a large swath of the market, many sectors that were just absolutely pummeled and brutalized. And out of that brutalization comes opportunity that we can exploit during earnings season this quarter.
Now you said macroeconomic, and those are some pretty big words for a lot of folks. Can you define that and describe what you mean by that?
Sure. Well, it's pretty simple. Capitalism is based on economic growth. And when there's questions about economic growth, it puts into question stock valuations. Stocks are valued based on a corporation's ability to produce and grow profits. And if the environment isn't conducive to growing profits, you're going to have weakness in share price. And so outside of earnings season, what you get in the marketplace is lots of speculation. And what I like about earnings season is that it shocks the market into actually focusing on reality instead of fantasy. And then a repricing of a stock has to occur immediately after the earnings report is released. And that's why you see really big jumps in share price up or down after earnings are released.
So let's dive into the 3 trends you see driving earnings this quarter. You already talked a little bit about how some of those trends will be manifested through Alcoa's results. If anyone wasn't paying attention, correct me if I'm wrong, Alcoa beat earnings by 5 cents, 7 cents versus a 2-cent expected EPS. But we'll talk about one of the core leading indicators, a new leading indicator that you see here in just a couple of seconds. But let's talk about the first trend here and what you mean by this, what you call the short-term reprieve from the earnings recession.
Well, it's really simple, John. The market, as it is and want to do, goes too far when it speculates. And the speculation was all about weakness in the U.S. economy in particular. And the reality is the economy and corporations have been, as a follower of earnings, I've been seeing it up close in the front row over the last 4 quarters. You're seeing earnings misses and sales misses on the top line that have been going on for the last 4 quarters. That changes in the first quarter. Wall Street expectations now have also been adjusted because of that weakness in 2015. And so as earnings season begins, you have expectations that frankly are too low. And so that's something that we can exploit. I think operating performance is going to be a lot stronger than folks are anticipating. And the stocks that have been languishing with earnings weakness, those are some of the names where you're going to see the biggest reversals in the first quarter of 2016.
So in your view, that's a shift from the first quarter going into the second quarter of 2016. Where is the strength and why is there strength?
Well, I think if you're looking at the most obvious place, you turn to the consumer. One trend that occurred at the end of last quarter is we saw a number of retail publicly traded companies in whether it's apparel or the restaurant space outperform expectations. And what was, I think, really telling was that it wasn't just the beat of the bottom line, it was the beat of the top line as well. And so if you're looking for early clues, this morning, Perry Ellis, for example, reported earnings. Now, they matched expectations on the bottom line, but they beat estimates on the top line. And because of that earnings beat, Perry Ellis shares are trading higher after the results are released. I think that's going to be playing out time and time again. Now, if you add in the fact that we have had really warm winter weather, that tends to lead to more consumer spending. At the same time, gasoline prices have been at historical lows. And so consumers flush with cash. The jobs market is doing better and continuing to show strength with salaries and wages going up. So I think the consumer is really the first place to take a look this quarter when you're looking for earnings beats.
Okay. And I'm going to tag on to that. I think for people who are trying to play the overall market, the difficulty for them with where the S&P 500 is right now is you're typically paying about 17 to 18 times forward expected earnings for 2016, which means the market as a whole is overvalued. But what you're saying is you're looking for those companies where that valuation is out of it's out of line with the overall expectations, which leads to essentially an opportunity for a company that's undervalued to pick up rapid growth in their share price, or companies which are overvalued and then miss their earnings to actually be beaten down again.
Yeah, that's absolutely right. And I think, again, the beauty, and to me, it's the safety of trading earnings, ironically, because a lot of traders run away from the earnings event, and really they shouldn't be, because it's one of the more reliable things that you can depend on, which is a reaction to the stock price based on actual information. And so last week, for example, we even though we trade in the prime earnings season for the 6 weeks, we're continuing to give our members trades in the what I call the postseason. We had a trade last week that on a market down day, we were buying call options, and the macro environment was absolutely crummy. To your point, stocks are overbought here. There can be no doubt about that. But it doesn't matter as far as the market reaction to the earnings event. And this particular company, when it reported on a down day in the market, shares jumped over 10%. And so those are the kinds of opportunities that we're looking to exploit during earnings season.
And you've now classified Federal Express as a new harbinger of earnings.
Well, yeah, and I may be overstating the obvious, although it doesn't get talked about, in my opinion, nearly enough. They say earnings season begins with Alcoa. Well, Alcoa is an old industrial aluminum company. And it used to be that Alcoa kicked off earnings season, and it was thought to be the bellwether of what's going on in the rest of the economy. Well, the reality is, I think a name like Federal Express is more interesting and a better gauge of the conditions in the economy. And also it's very telling from a standpoint of market valuations. You had Federal Express, a very well-known company, a company that there shouldn't be much variance in its valuation, one would think. Despite earnings coming in way better than expected, you had the stock jump over 10%. Federal Express is not a stock that moves 10%. That action in the stock after earnings, I thought, was the biggest clue to what's going to transpire this up, and it's really exciting what's going to happen this current earnings season. You have lots of inefficiency, mispricing of stocks, whereby operating results are going to snap the market back into reality and result in big moves in share price. But if you're looking for the health of the economy, Federal Express tells us that things are a lot better than people are expecting.
And again, to add on, for those who want to think in a broader context, where the reason that Federal Express is important is not just because it's a shipping company. It's also because of the companies that have a relationship with Federal Express as their primary shipper. For example, Amazon.com now does their home deliveries, especially their faster deliveries, are done using FedEx. So when you see FedEx doing really well, you could translate that into the suggestion that a company like Amazon or other home delivery companies that are delivering things to the consumer, are doing well. Not a bellwether, but another company obviously to watch is UPS, which reports later in the season. But between those two companies, you're looking at the movement of products, of goods across the country, especially within the US, but also globally. And that really gives you some insight, as Jamie said, into what's happening in both the US and the global economy. So when those companies are doing very, very well, that suggests that the consumer is also doing well. The consumer is spending money. But let's roll back to the train wreck, because this is I think one of the fun aspects of what you do, which is, from one quarter to the next, you get to see the motion, if you will, of the ebb and flow of earnings, kind of like the sea rising and falling. This quarter, you're calling it the revenge of the train wreck.
Yeah, well, and I mentioned the stock that we traded last week. The name of the company was Bed Bath & Beyond, and that was an example of strength in the consumer and low expectations. But it's also an example of the revenge of the train wreck. You had shares of Bed Bath & Beyond were absolutely pummeled heading into earnings. And when the numbers come in better than the reduced expectations, it triggers a correction in the valuation. Again, those are things that can be anticipated in advance. And if you can anticipate it in advance with a very simple call or put option, you can generate explosive returns for your portfolio. And during the first quarter, there were dozens upon dozens of what I would call absolute earnings disasters, where stocks lost substantial value after reporting disappointing results. You look at a company like LinkedIn, for example, its shares lost 50% of their value after a disappointing earnings report. And so Valiant was another one where their shares were pummeled after earnings, and the stock prices plunged. As is often the case, things in the market, when it comes to speculation, goes too far. And so part of what we're doing here is taking a contrarian opinion and believing that no recession is not occurring. Yes, we have some economic softness in the first quarter, but given the strength in the jobs market and all of the other economic indicators that go into determining whether or not you are in a recession, we're about as far away from a recession as you can be. And so I think that gives the opportunity for some of these train wreck stocks to rebound.
Great. Actually, that's a repeat. There we go. So what does that mean? What's that rebound, and how does that happen? I mean, how do you capitalize on that?
Well, you need a trigger, right? And the trigger for us is always the earnings report. We only place trades around earnings, unlike the traders that are running away from earnings. And we place our trades immediately before results are released. So for Bed Bath & Beyond, we were buying call options immediately before the market closed, before earnings were released. And that trigger for a reversal was the actual operating results being released to the market, and investors having to re-gauge what the fair value of that company is. See, the finance people will tell you that the value of a stock is its discount of future cash flows. Well, what goes into cash flows? That's profits, right? So if there's a change in what the expectations are for those profits, there has to be a change in share price, and there always is after earnings.
So one of the things that you've been talking about so far, and I know that we've been talking about this at length over the last several months, is the bears sort of having their foot in, but then results come out, and what happens?
Yeah, well, again, it doesn't take much to trigger a short covering rally. You know, the Adam Smith said the goal of the corporation was to profit. And while companies where there is change in their industry or there's intense competition, from time to time can have difficulties, no doubt about it. But ultimately, things are never as bad as what the bears are going to tell you. Companies do not die very easily. Even some of the names that you think shouldn't be around anymore, like a Sears, for example, a Kmart. I mean, those businesses have languished for many years now, to be honest, and yet they still haven't died. My point is, when a stock loses significant value, it doesn't mean the company is dead. And each quarter, there's a new opportunity for management to prove that the company is on the right path to generating profits and growing profits. And if they can prove that point, the bears have no choice but to cover their short positions.
So you're looking forward to more earnings recoveries in this coming quarter than the market presently expects.
I am, and I guess, you know, with the caveat, John, that it's always on an individual basis. You know, there are certainly going to be companies that miss expectations in the quarter, and we're going to trade those as well. But I think what I'm doing here with this presentation is identifying the big macro trends that people need to be aware of when they're doing their own analysis on individual stocks. And if you've identified something of a train wreck, I think the most likely outcome for the current quarter of earnings is going to be better than people expect, and then you can therefore trade on it.
And that segues right into the idea of premium stock valuations, which we talked about a little bit earlier. And give us a little bit of background on why this is an important trend.
Right. Well, it goes into your point too, where stocks are trading at the top end of their trading range, at the top end of their historical valuation range. It's at a time when earnings results are contracting, where sales numbers are not meeting expectations, earnings are not meeting expectations, et cetera. And so I think it's a very difficult market to generate any sort of momentum. And the danger, while owning momentum stocks and trading momentum stocks, I'm all for it in the right conditions. But I don't think these are the right conditions for owning a premium valuation stock. There's way too much risk where any sort of hiccup in the operating results, and it doesn't have to be just the sales or the earnings. It can be something like subscriber numbers for a stock like Netflix, for example. Last quarter, a little bit of disappointment there, had the stock trading down some 15%. So you get really violent reactions when momentum fails to deliver.
And you saw much of this begin last quarter in sort of a response to the end of the fourth quarter 2015. We saw that with LinkedIn was a very good example. LinkedIn shares down 25% in one day, if I remember correctly.
50%.
Back in 50%. That's right.
Yeah.
So but there seems to be, to me, and I just want to work with this based on some of the bullet points here. You have to strike a balance when you're looking at the individual stocks to trade earnings between those companies that are train wrecks and their opportunity to get back on track versus stocks that are highly valued or richly valued and the risk or potential of the stock going down. So what is it that you look for that puts the odds in somebody's favor?
Sure, and actually, I think you're touching on a critical point of trading earnings. That ultimately, you can arm yourself with all of these tools and trends, but you still have to do the individual analysis on a case-by-case basis. And so, I look at LinkedIn, for example, and I put it in the category of being a train wreck that, despite a high valuation, there are some compelling factors. We're not going into what are the determining factors to make a good earnings trades. That's a training session in and of itself that we won't go into here. But suffice it to say, when you do that analysis on LinkedIn, it puts it in that category of a potential reversal after being a train wreck. Netflix, its shares recovered after it experienced its own train wreck and have held pretty steady at a very high premium valuation. And I'd be very leery of Netflix. And in fact, Netflix reports early next week. So it to me is a momentum stock that you have to be very careful. Any sort of bad news could result in a 10, 15, even a 20, 25% decline like we saw last quarter with LinkedIn.
So for everybody watching, you're looking for companies that are momentum stocks. They're going to be at the top of their ranges. You're looking for the potential for that stock to decline because they miss earnings. Even though they're a momentum stock, even though they're at the top of their ranges, that's where you tend to see those types of falls occur. And at the same time, you're looking for companies which have been beaten down in their stock prices following their previous earnings announcement, which should be able to recover this quarter. So as some examples of that, let's talk about three stocks to trade that fall within the categories of these three trends, Jamie. And the first one is Buffalo Wild Wings.
Right, and I think that Buffalo Wild Wings is a great stock to trade. This is a selection based on the first trend of no, we are not in a recession. Buffalo Wild Wings is the quintessential American company serving up beer and wings in sports. And in the first quarter, you had a lot of sports. You had the Super Bowl. You had the winter sports, hockey and basketball gearing up. You don't have to worry about fluctuations in the value of the dollar. Buffalo Wild Wings is a domestically based company, and disappointing results during earnings recession over the last 4 quarters really sets the table and lowers the bar of expectations for Buffalo Wild Wings to do well in the current quarter. So I think the stock's oversold as we go into the earnings report. The valuation relative to expected profit growth is now actually pretty attractive as it's ever been really in the last 12 months. And Wall Street, I think, is optimistic, even though the bar has been set low. Those estimates have been holding firm over the last 90 days, which tells me the bias is on the upside here. And so I would be buying call options on Buffalo Wild Wings
and
before they report earnings.
We'll circle back with everybody and give you some details on how to make a trade like this in just a couple of minutes. Next up is another transportation stock, Union Pacific.
Yeah, well, and I wasn't even looking to be funny with Union Pacific and the train wreck analogy, but it really does apply in that no sector over the last 6 months has been beaten down like the transport sector. Trains in particular, trucks as well, were hit hard by selling in the fourth quarter and first quarter of this year. Valuations really were chopped in half. Unlike a LinkedIn that lost 50% of its value in one day, these train and truck stocks have lost 50% of their value over the last 6 to 9 months. And so train stocks have been slammed in 2015. You had the oil price decline and attack on coal negatively impact their shipping rates. And you also just had the transports leading the bear calls for a recession. And because a recession isn't happening, I think Union Pacific is set up for a reversal here. There could very well be the light at the end of the tunnel. I think the numbers are going to be better than people anticipate in the first quarter. You've had, for sure, no recession looks to be taking shape in 2016. That's important because it's guidance. We don't talk about guidance a lot here, but guidance also factors into what happens with the stock after earnings. And so I think you're going to have some positivity in guidance. Stronger economic activity can be expected in 2016. And the fact that estimates have dropped tells you, the hurdle rate is very low. So put it all together and, you can see, start the comparison to Federal Express that shippers are doing well. You've had a lot of shorting that's resulted in that 50% discount to valuation. And really, we're just playing the odds here. I don't have a crystal ball. I can't tell you definitively what's going to happen. But the mixture of our analysis and experience tells us that you want to be on the long side here before earnings are released.
And our upcoming train wreck stock, Chipotle Mexican Grill.
Yeah, I think this is could be the short of the decade. Chipotle was a hero momentum stock, before they ran into a little microbe called E. coli. Tricky little bugger, that can destroy a business more quickly than anything else out there, and it's doing just that to Chipotle. But Wall Street loves this stock, and they are defending the heck out of it with expectations that the company is going to put things together and right the ship in 2017. I think that's just wishful thinking. If you go to your neighborhood Chipotle, you can walk right in and be served immediately, whereas previously it was a 30-minute wait in some cases. The lines were super long and all of that kind of stuff. I think the millennials and Gen X customers that were feeding the growth in Chipotle, and really it was a fantasy. The myth of healthy food fare at Chipotle I always found amusing. They can sell a 1,500 calorie meal and tell people that's healthy. I'm amazed at that. But be that as it may, the facts are their business declined severely after E. coli, and people aren't going back. And I certainly won't. So the way to play this one, I think the collapse continues in 2016. Earnings are going to be an absolute train wreck for Chipotle, and you have a premium valuation on this still momentum-based stock. I think you can see a 25 to 50% reduction in valuation if the news is bad enough.
Well, that gets down to how to execute the top 3 trades. And just very briefly, everyone, this is how in our earnings player program, we execute earnings trades. And I'll give you a little graphic at the end, just as a very simple primer. When we make recommendations, we place those options trades at 3 p.m. just prior to the earnings announcement. So we'll give you an example here with each of the three trades we've just talked about. So you would place the trade at 3 p.m. and then close it out the next day, typically within the first hour of trading. Now, the timing on this is important because, as you like to say, Jamie, you want to isolate the earnings event for the maximum potential pop in that options contract. So you're placing this trade just before the actual earnings announcement. So if a company reports after the market close on a Tuesday, you're placing your trade at 3 p.m. on that Tuesday. Or if the company reports before the market open on Wednesday, you're still placing that trade in the afternoon on Tuesday, correct?
Yes, and I think it's important to know that we are isolating the earnings event. There are a lot of traders that will look at the analysis that we do, and in some cases, without trying to pat my own back, but we're fairly prescient at what we do here, and that might give you an itchy trigger finger, if you will, and we don't want people to do that because you open the door to too many outside external factors and speculation that can ruin a trade. So you place the trade right before the market closes, before results are released.
So here's the step-by-step on Buffalo Wild Wings. Again, this would be a call option. You would buy that call option just before the earnings announcement. Presently, the earnings report comes out on April 26th after the market close. So you would buy that call option at 3 p.m. on April 26th. Those call options should be at or just in the money. And then you want to close the trade the very next day, April 27th, after 10:30 a.m. And that gives you the best opportunity to capture the maximum potential in that trade. For Union Pacific, they report on April 21st before the market opens. So for that call option, you would place that trade on April 20th, the day before at 3 p.m. Those options should again be at or just in the money, and then you would close the trade the same day that the report is actually coming out. That they come out before the market open on the 21st, so you would actually close that trade within the first hour or just after the first hour of trading on April 21st. And finally, the last trade, Chipotle Mexican Grill, they report also on April 26th, as does Buffalo Wild Wings, after the market close. So you would place that trade at 3 p.m. on April 26th and then close the trade the very next day on April 27th. So there's three simple trades. The process, again, is very, very simple. You're buying an option here, so it's either a put or a call option. You're placing that trade at or just in the money. Excuse me, you're buying that trade, that contract just at or in the money, and then closing that trade the very next day within the first hour or just after the first hour of trading. It's that simple. That's one of the reasons that this has worked over the years, is because of its simplicity in execution. And at this time, we'll turn over into and come back, and Jamie, I'll have a couple questions for you in a second, but we'll do our quick invitation for those of you who want to be able to take advantage of additional trades throughout earnings season. We are opening up the Earnings Player to our quarterly membership. We have about 44 seats left, if I remember correctly here. And as I said at the top, this is specifically for investors or traders who want to get some fast growth in your trading account, because the Earnings Player season, the primary season, lasts 6 weeks. That in the postseason, as Jamie said, we will make additional trades in the following 7 weeks, which lead up to the next quarter. So there's always a trade to be made. When we get the trade analysis correct, when we have the maximum potential movement in the options, that's when you will see these gains of 100 to 500%. And this is what allows you to go big gain hunting. You're not placing hundreds of trades. In fact, we only place about 5 trades a week at the top side. Some weeks we'll place as few as 3 trades. Some weeks as few as 1 trade. It depends on what the market gives us and what the analysis shows us. But as I just showed you with the execution process, this is a simple, repeatable system which you can use all year long. So here are some actual trade results, and then we'll get into the details of the Earnings Player service. Dick's Sporting Goods, last year we generated a 241% gain on a put option. Cummins, this is one of Jamie's favorite trades from fourth quarter last year, a 377% move on a put option within the first hour. So these are very rapid moves. You're following the exact same process. These are the actual recommendations that we put on last year. year. I mentioned earlier, Green Mountain Coffee. We did this trade last August. It was a 486% gain because they missed their earnings expectations as we projected, and boom, went the option. And even as Jamie talked about, Bed Bath & Beyond being an off-season trade. This was one of our other ones last year, Best Buy, which beat their earnings, and we had a call option recommended, and that call option was up 351%. So now you can go it alone. You can certainly try and work this out on your own. We have a 5-step process, which we detail on the page below here. So you can try to scour the markets for potential trades and go through hours of data, estimates, calculations, options chains, news headlines, and charts, or we could do all of that hard work for you. This is your chance to join us for the new quarter starting here in April 2016. This is your ability to unlock the huge profit potential that's available to you during earnings season. This is the Earnings Player. And we're about to get started on April 18th will be the start of the new regular season. We run again for 6 weeks from that date with our prime season. We make weekly recommendations every single week during earnings season. We make off-season recommendations. I'll come back to that in just a couple of minutes. But the best part about this, again, is it's not day trading. You don't have to sit in front of your computer. You don't have to scour the market for trades. We do that work for you. You simply place your trade at 3 p.m. on day 1 and close your trade at 10:30 a.m. on day 2. It's that simple. So the Earnings Player, this is how it works. Each week we make up to 5 trade recommendations. These are the trades where we've projected the biggest potential gains, all things being equal. In other words, these are the trades which have the best potential for those gains in the 100 to 500% range. Now, so those trades between April 18th and May 27th, those are the 6 primary weeks of earnings season, up to 5 trade recommendations every single week. Some weeks we'll have, we may only have 3 or 4 trades. Again, it depends on the market. It depends on the stocks in question. We also have to take other factors into consideration, like the overall market, what's happening in the global economy, the global markets, if you will. So some weeks we may only have 3 trades, but they're still going to be our 3 best profit potential trades. We also make additional trades during the off-season. Off-season in this next quarter will last from May 30th until July 5th. So it spans that 7 weeks until the next earnings season begins when Alcoa reports in mid-July. So during the off-season, Jamie will typically make 1 to 3 additional trades. Usually it's 1 or 2 trades a week. A couple of weeks ago, we had 3 trades because it just worked out that way. But these are additional trades, which again, give you, like Best Buy, again, 200, 300, 400% potential gains. Now, what Jamie does for you is his unique expert 5-step analysis on each of those trade recommendations. First, he's identifying which trades should be made, which trades have that profit potential of 100 to 500% gains. He gives you and runs through the actual estimates on the company so you understand why there's a disparity between what Wall Street expects and what the company is most likely to report. He talks about the fundamentals, the charts, and the news headlines, all of which collectively help him to identify the best trades to make each and every week. Then he gives you the expectations for those earnings, whether he expects them to miss or beat, and he gives you the actual trade to place, whether it's a simple put or a simple call. And those trades then come with the specific trade instructions so you know exactly when to execute the trade and the specific trades to execute. We'll give you an example here in just a moment. We also provide, now these are all going to be weekly options trade recommendations. It's the rare occurrence where we'll use a monthly option, but for the most part, we focus on weekly options. And the primary reason that we focus on weekly options is because it gives us that best opportunity for profit potential in that short space of time. If you use a monthly option, unfortunately, too much can happen between you buying that option and the expiration date of that option. So and as I said, trade recommendations are very simple options trades, buying a put or buying a call. Here's an example. This is the Best Buy trade, which you can see on your screen. We told our members to buy Best Buy, the $30 August 28th expiration calls, when to execute that trade, and then we help them to close the trade out the very next day for that 350% gain. So here's what happens for you as a member. You get your trades every week for the week ahead on Monday, typically by noon Eastern time, and those are delivered to to you by email and also on our members website. I'll show you how to get into that here in just a minute. Again, all trades, the vast majority of trades are going to be weekly options. It's been the rare occurrence where we've used a monthly. The only time we've ever used a monthly is for a stock that didn't have weekly options available to it. And even so, we were still in and out of that trade quickly. You would enter your trades at 3 p.m. on what we call trading day. Trading day is that moment just prior to the earnings report. And then you're exiting your trades typically by 10:30 a.m. the next day, regardless of result. And well, if for any reason we need to change or cancel a trade, it has happened from time to time, you'll get an email and an SMS alert if we need to take a trade off the table or if we need to change a strike price on any of our trades. So we give you all of the details, all of the specifics for executing the trades with us each and every week on Mondays by noon Eastern. That's where you get your weekly green sheet, which tells you all of the trades that you're going to make for that week ahead, so you know exactly when to make them, which days to place them, which days to close them, and which options trades you're actually making. So now, a couple of other points here. This is sort of a compendium of questions that we've gotten over the years. And although we use simple options trades, those of you who are more expert options traders can use the analysis we provide to build your own spreads, straddles, or other advanced options trades. There's no reason that you can't use those. The only reason that we stick to the simple options trade is for maximum profit potential. That's what we're after here. If you use spreads or other options tactics, they will reduce your cost to enter that trade. They will reduce your risk in that trade, but they do also reduce your profit potential. That doesn't mean you can't use them. It doesn't mean you shouldn't use them. It just means you need to understand that up front. And so again, our reason for using basic options trades is that maximum profit potential. We want that 350 to 400% gain in the option itself. And ultimately, the other reason is there will be losing trades. Even if we get the analysis 100% correct, the market may not give us the move that we wanted. It does happen. It will happen. In some cases, we will have all of the ducks lined up correctly, and the company will surprise to the upside or to the downside. This is unpredictable, but when you put the vast majority of the odds in your favor, you're going to get most of the calls right. But that does mean that from time to time, you're going to have losing trades. That's the key thing to understand here. There will be trades that don't work out. That's why we use the simplest of options trades, so that when we have the winning trades, they make more than the losing trades. And I'll show you an example of this in just a minute, because the way that we always position this program is it is a money management service. The members who have been the most successful with us have used a systematic approach to achieve their results. That means they're taking all of the trades. They're not trying to cherry pick. They know that they're going to have winners. They know they're going to have losers, but they're not focused on any one transactional event, any one trade. In other words, they're not cherry picking and hoping that that one recommendation is going to be the big winner, and they put all their money in it. That's the wrong thing to do. In fact, what we recommend is that you buy no more than 1 or 2 contracts per trade that we recommend. And that limits your capital risk, but it doesn't prevent your profit potential. So let me give you an example of what I mean by that, because here's a great quarterly example where we had more losing trades in the quarter than we had winning trades. And yet, the quarter returned a 39.5% overall gain. Now, what you're looking at here is the summer of last year, 2015. And as you can see, we had 12 winning trades and 15 losing trades. So out of 27 total recommendations in the primary 6 weeks of earnings season, we had 27 trades. 15 of those trades were losers. Now, not every trade lost 100%. Many of them lost 100 or close to 100%, but you could see that there were some that lost 47%, as low as 50%, 46%, even a 5% loss. So not every trade is going to lose 100% of your capital. But the key is that when you get those winning trades, that they significantly outperform the losing trades collectively. And that's what you need to focus on. That's why I say this is a money management service. That's why we say you don't have to focus on any 1 week, any one trade. A good example here, 1 week alone returned two 100+% winners. You can see the two greens together there on Panera Bread and Buffalo Wild Wings. You can see we like trading Buffalo Wild Wings. So we had call options, and both of those produced money doubling gains. In the same week, we had a little 30% winner, but we also had a 100% loser. So if you just took one of those trades, you might get the wrong trade. But if you took them all together, you made money that week. And that's how, and that's why. So again, winning trades win more than the losing trades. And you can see the results at the bottom, a total of $5,500 in capital expended. This is based on a single contract per trade. So we're not inflating the numbers. We're not conflating the number of contracts. So $5,500 spent. So over those 7 weeks, you roughly spent about, $800 per week. Across the trades, you can see that, and it returned $7,700 by the end of the quarter. By the end of the primary weeks, so it was a 39.5% total gain. This is how Earnings Player succeeds. But I'll be perfectly honest with you, it's not for everyone. If you can't handle a losing trade, this is not going to be the service or program for you. If you understand that you need to win more than you lose in the percentages of the trades, this service is for you. Again, it's all about money management. We've averaged 28% total gains per quarter throughout 2015. 2016 is just underway. We had a small gain for the first quarter of 2016. Our results are not finalized, but they're close. But again, it's a matter of taking all of the trades, being consistent in the application, and understanding that some of those trades aren't going to work out. So as I said, don't need to win every trade. You don't have to have 100% winners to come out ahead. There's no service that does that. No service that provides 100% winners. As I said earlier, we may get the call right. The stock may not move in our favor, but your best success will come from limiting your exposure to just 1 or 2 contracts per trade. It doesn't prevent you from turning profitable trades. It prevents you from losing significant amount of money over the season. So as a member, your benefits include, as I said a little earlier ago, the weekly green sheet. You get this every Monday during earnings season. This is a full quarter, even though the vast majority of your trades will be made in the first 6 weeks. It includes up to 5 trade recommendations for the first 6 weeks, and then additional trade recommendations as they occur through the rest of the season. We give you the specific options, trade instructions, the option, the strike price, everything you need to know, the date, so you know when to place the trade, where to place the trade. And as we've talked about, some weeks will have more opportunities than other weeks, but we want the best profit opportunities with the least amount of risk. Inside your green sheet, we do the analysis, we give you the trade instructions, we also do capital management for you, so you know how much money it's going to cost you to place each of the trades based on a single contract, so you know what your capital expenditure is for the week ahead, so that you know what your capital risk is. We do all of the analysis, why Jamie thinks the company is going to beat or miss earnings, what the numbers tell you, what the news, the chart, the fundamentals tell you, and then the specific trade instructions, whether you're buying a put, whether you're buying a call, the weekly expiration you're buying, and when to place that trade. You also get our trading calendar. This is just another view of the green sheet. The trading calendar is available on the members' website. It shows you exactly which dates you're going to open those trades. And we also track the estimated results, the estimated capital and the results of each of those trades on the trading calendar. Plus, one of our favorite new additions to the service is the Market Open Trading webinar. Now, you can join Jamie live every weekday at 9:20 a.m. for closing trade instructions. So every morning when we've put a trade on the day before at 3 p.m., you can join Jamie at 9:20 for about a half an hour, and he will walk through the market open, watch the trade or trades that are currently running, and give you updated instructions on how to close that trade. This is for those people who want to take a little extra risk or who want to try to maximize a little more profit. That's what these webinars are for. You get an analysis right there on the spot. What's happening? What's driving the price? What should you do? In addition, as I said, we give you special opportunity trades the rest of the quarter. And if anything ever happens to one of our trades before we place it, we'll make sure you know. Now, it has occurred in the past where a CEO goes on CNBC to pre-announce an earnings in some fashion, an earnings expectation, or to give away the store, if you will, and poof, our trade gets just evaporates. So, it's happened a couple of times, but if it does and we have to take a trade off the table, we'll tell you to remove that as well. If we need to change a strike price because of the movement in the stock price before earnings announcement, we'll make sure to update you on that as well. That's why you always want to wait till that 3 p.m. on trading day to place that trade. And there's also instant email help. If you have questions, Jamie is available to answer them via email. Now, some of the results from members who are currently in the program. Michael told us about banking $2,700 one week, banked $2,700 the week before. FM told us that throughout 2015, he took $4,800, turned it into $11,980, which is a 149% increase in his capital. And one of the most shocking results came to us from Tom. This is last July. He's been with us for 6 quarters, started with $10,000, slowly increasing the size of his trades as his account grew, and he was at an all-time high of $46,000 as of last summer. That's what's possible, folks. So the deadline to get in as an Earnings Player member will be 11:59 p.m. on Sunday. You get your season pass reservation in right now today, right here on this page. Full quarter, the first 6 weeks of the primary seasons, that's where you get up to 5 trades each week, and then additional trades in the weeks that follow. $199. Everything included, the member's website, your weekly green sheet, all the trades, the trading instructions, the live market open webinars, the email help, everything you need is all included here. You get our best trades during the earnings season. You get the Earnings Player green sheet, the Earnings Player trade calendar. This is very important. This is the easiest and fastest way for you to know when to place your trades each week and to make sure that you're on top of the game. You get all of our trade alerts and updates. We give you additional emails to make sure that you're up on what's happening in the overall market. We have several bonuses that we included. Again, the market open webinars, SMS alerts and updates when necessary, the off-season trades, and the off-season weekly market outlook. This is where you can also go hunting for additional trade ideas on your own, but Jamie's done much of the analysis and names the stocks that you should be looking for with that. So once again, deadline is 11:59 p.m. on Sunday because the green sheet will be out on Monday at noon. So you want to make sure you get yourself in right now so you're ready to go. Your first trades will be in your hands at noon on Monday. If you have questions, if you need help ordering, you can call us. The number is right here on the screen. It's also on our checkout page. The link to order is right here on this web page. So just get the button. Get your season pass reserved right now. It's going to be really a spectacular quarter. As we've talked about, between train wrecks and high flyers, the opportunities are limitless for us this quarter. So, Jamie, any last thoughts, any last words before we sign off and move on?
Last quarter, I talked a lot about volatility, and you had in the overall stock market a ramp up in gyrations. That really made trading earnings difficult. You mentioned it. Our profits were smaller last quarter because of that. However, the flip side of that is volatility has collapsed in the overall market as we head into this quarter's earnings season. And so I think we are poised for a quarter similar to the summer of 2015. And in fact, I'm expecting a really, many 300-400% gainers this quarter because of the inefficiencies in pricing. So I think it's going to be a great quarter. As you said, our winners win more than our losers lose, and I think that's going to really be the theme of this current quarter.
All right, that's it, folks. Register on the page right here. Get your season pass in. Earnings Player, it gets underway Monday, so you want to get in before 11:59 p.m. on Sunday. After that, the registration page will close, and we won't be allowing any more members in. Sign up today. Join us. If you're looking for those big gains, if you're looking for those 100 to 500% winners, we have them, and we're going to help you find them. That's for everyone here at the Earnings Player and Traders Reserve. I'm John Hutchinson, along with Jamie DeLugash. Earnings season is now officially open. Have a good day.